In August 1971, President Nixon made a decision that changed money forever. He closed the gold window, which means you cannot convert your dollar into gold anymore. Everyone thinks this was a choice between sound money and reckless printing. It wasn't. Here's the real question. What if Nixon had kept the gold standard? What if he'd maintained the $35 gold peg and defended it no matter the cost? Would America be richer today? Would we have avoided inflation, the debt crisis, the monetary chaos of the last 50 years? The answer is going to surprise you, because if Nixon had kept the gold standard in 1971, the US would have entered an immediate, brutal deflationary depression. Unemployment would have spiked to double digits as the Fed crushed the money supply. Then, in October 1973, when oil prices quadrupled, the system would have failed catastrophically anyway, forcing an emergency closure under far worse conditions. The gold standard was already dead in 1971. Nixon just made it official. But that raises bigger questions. When did it actually break? Why couldn't we save it? And what did ending it actually do to us? Let me walk you through each of these, because the answers aren't what you think.
The strength of a nation's currency is based on the strength of that nation's economy. And the American economy is by far the strongest in the world.
Here's what most people don't know. The Bretton Woods system didn't break in 1971. It broke in the early 1960s, and we spent 10 years pretending it was still alive. The Bretton Woods system, established in 1944, worked through a simple mechanism. Foreign currencies were fixed to the US dollar. The dollar was fixed to gold at $35 per ounce. Foreign central banks could exchange their dollars for gold anytime they wanted. Simple. At first, this worked perfectly. The US held roughly 3/4 of the world's gold in 1944. That made the promise credible. But as global trade expanded through the 1950s, the world needed more dollars to function. And the only way to supply those dollars was for the US to run deficits, sending dollars abroad through foreign aid, military spending, and investment. Now here's the problem. As more dollars went out, foreign central banks accumulated more dollar claims. Those claims were supposed to be redeemable for gold, but US gold reserves weren't growing. Gold production is slow. You can't just print gold. So the ratio started shifting. In 1950, we had enough gold to cover our dollar obligations. By 1960, we didn't. In the early 1960s, foreigners held more dollars than we had gold to redeem. The math was simple and brutal. If everyone asked for their gold at once, we couldn't deliver. That's when the system broke. Not in 1971. In the early 1960s, we were functionally bankrupt, but we kept the lie going for another decade. The US government knew this. Economist Robert Triffin warned Congress about exactly this problem in testimony. He predicted that US deficits would flood the world with dollars beyond what gold stocks could support, sparking runs and eventual collapse. Policymakers dismissed it. They thought they could manage it. They were wrong. Treasury officials saw the numbers getting worse. They created temporary measures to hide the crisis, things like the London Gold Pool, where 8 central banks agreed to coordinate gold sales to keep the price capped at $35 per ounce, currency swap lines with other central banks, capital controls to slow dollar outflows. These were band-aids on a gunshot wound. And here's what made it worse. These temporary measures masked the severity of the crisis from the Federal Reserve. The Fed thought things were under control, which gave them freedom to focus on domestic goals like keeping unemployment low. So the Fed printed money to support growth, which created inflation. U.S. inflation went from 1.6% in 1965 to 4.3% in 1968 to 5.8% by 1970. That inflation spread to other countries through the fixed exchange rate system. The gold standard was supposed to prevent this. It was supposed to impose discipline. But it wasn't working anymore because domestic political priorities had taken over. By 1970, we owed foreign central banks 4 times more gold than we actually had in Fort Knox. 4 times. The system was mathematically impossible. And what would have happened if someone called our bluff earlier? Here's where it gets interesting. France almost did, multiple times. French President Charles de Gaulle understood what was happening. He saw that the US was running deficits, printing dollars and exporting inflation to Europe, and he decided to call the bluff. But here's what most people don't know. France didn't just send 1 battleship in 1965. That was the public threat. Before that, from 1963 to 1966, France executed a secret operation called Operation Vide-Gousset, which translates to Operation Empty Pockets. France secretly repatriated 3,313 tons of gold from New York and London, 44 boat trips, 129 flights, all covert. They were converting their dollar reserves to physical gold before anyone noticed, fearing the US would devalue the dollar and leave them holding worthless paper. This wasn't a diplomatic negotiation. This was France executing a gold heist, moving massive quantities of physical bullion across the Atlantic while publicly pretending everything was fine. When de Gaulle finally sent that battleship in 1965, it was theater. The real gold was already gone. And here's the kicker. France made an absolute fortune. That gold they moved at $35 per ounce. By 1980, gold hit $850 per ounce. France's secret operation turned their reserves into a 24-fold windfall. If other major countries had joined France, if Germany and Britain and Japan had all demanded gold simultaneously in 1965, the system would have collapsed right then. The US would have run out of gold in weeks, maybe days, but they didn't. Germany wanted American military protection against the Soviet Union, so they kept holding dollars. Japan needed access to US markets for their exports, so they kept holding dollars. Britain was broke and couldn't rock the boat. Still, we came within days of chaotic collapse multiple times between 1965 and 1971. In March 1968, the London Gold Pool, that secret consortium of 8 central banks trying to cap gold prices, sold 1,000 tons of gold in a single week. That's 1 million kilograms of physical gold moved in 7 days. They were dumping so much gold that the weighing room floor at the Bank of England physically collapsed under the weight. Think about that. The actual floor gave way from stacking too much gold. U.S. Air Force planes were rushing gold from Fort Knox to London amid panic buying. France had already exited the pool in 1967, which doomed it. The remaining central banks couldn't hold the line. The crisis got so bad that the U.S. begged Britain to close the London gold market. Queen Elizabeth II declared a bank holiday on a Friday in March 1968, shutting down the market to prevent total meltdown. This required a parliamentary petition. The Queen of England had to intervene to save the dollar. That same week, Congress repealed the requirement that the Fed hold gold backing for domestic dollars. The system was being dismantled piece by piece, but even inflation alone was destroying the cooperative arrangement. When your reserves are losing 5% of their purchasing power every year due to U.S. inflation, even friendly countries are forced to convert to gold. The math doesn't care about diplomacy. Germany's central bank could watch their dollar reserves depreciate or convert to gold before the value disappeared. They chose conversion, just more slowly than France. By August 1971, we were out of options. Switzerland left the system on August 9th. Britain requested $3 billion worth of gold be moved from Fort Knox on August 11th. The run was starting, and this time, there was no stopping it. Nixon closed the gold window on August 15th because waiting any longer meant total chaos. Markets would have panicked. Gold would have drained completely. The dollar would have collapsed. The system had been dead for 10 years. Nixon just announced the funeral.
Accordingly, I have directed the Secretary of the Treasury to take the action necessary to defend the dollar against the speculators. I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets.
This is the question gold standard advocates always ask. If we just had more gold reserves, the system would have worked. No, it wouldn't have. And here's why. The problem wasn't the amount of gold. The problem was the Triffin Dilemma, and more gold just delays the inevitable by a few years. Let me explain how this works. The global economy was growing at roughly 4 to 5% per year in the 1960s. Now, that means the demand for dollars to conduct trade was also growing at 4 to 5% per year. To supply those dollars, the US had to run deficits, sending dollars abroad. Gold production, on the other hand, grows at maybe 2% per year, sometimes less. You're limited by how fast you can discover new mines and extract the gold. So you have demand for dollars growing at 5%, but gold supply growing at 2%. The gap widens every year. Eventually, dollar claims exceed gold reserves. It's mathematical. It's inevitable. Now, let's say the US had twice as much gold in 1960, double the reserves. Does that save the system? No, it just delays the crisis. Instead of becoming insolvent in the early 1960s, you become insolvent in the late 1960s, maybe 1968 instead of 1962, but the outcome is the same because the growth rates haven't changed. The economy still needs more dollars than gold can support. Robert Triffin warned about this exact mechanism in 1960. He showed policymakers the math. Some economists later argued that balanced budgets could have prolonged Bretton Woods, but prolonged doesn't mean saved. You're just buying a few more years before the structural contradiction destroys the system anyway. Even if the US had 10 times more gold, you just delay it to the mid-1970s. But here's what would actually happen. With that much gold, the US would run even bigger deficits because the constraint seems looser. More spending on Vietnam, more Great Society programs, more dollar outflows, and you'd hit insolvency faster, not slower. The Triffin Dilemma is structural. It's not about the quantity of gold, it's about the impossibility of one country's currency serving as the global reserve while maintaining a fixed gold peg. The world needs growing liquidity, but gold is finite. Why didn't we just switch to a different commodity? Here's another question people ask. Okay, gold didn't work. What if we'd used oil, or silver, or a basket of commodities? Same problem. Any commodity-backed system has the same fatal flaw. Let's take oil. The global economy in 1970 consumed about 50 million barrels of oil per day. By 2020, it consumed 100 million barrels per day. Oil production doubled, but economic output grew much faster. GDP increased six-fold in real terms. If you'd fixed the dollar to oil in 1970, by 2020 you'd have the same problem. Dollar claims exceed the physical oil available to back them. The economy outgrows the commodity. What about a basket of commodities? Gold plus oil plus silver plus wheat plus copper? Still the same issue. The total supply of all commodities combined grows slower than the economy. You can't mine and farm fast enough to keep up with economic growth. Here's the deeper point. The problem isn't which commodity you choose. The problem is trying to tie a dynamic, growing economy to a fixed physical supply of anything. In 1800, this worked fine because the economy grew slowly. Agricultural societies don't need rapid money supply expansion. But in a modern industrial economy with productivity growth, technological innovation, and global trade expanding, you need a money supply that can grow with the economy. Commodity standards can't do that. They impose artificial scarcity on money even when the real economy is producing more goods and services. That creates deflation, which kills growth, which creates unemployment, which causes political crisis. Every commodity standard eventually faces this choice: break the peg or accept depression. And every time, governments choose to break the peg. Spain did it in the 1600s when they debased silver coins. Britain did it in 1931 when they left the gold standard. The US did it in 1971. It's not about bad policy, it's about mathematical impossibility. On August 15, 1971, Nixon announced on national television that the United States was closing the gold window. Dollars would no longer be convertible to gold. He also imposed a 10% import surcharge and wage price controls. International leaders were shocked. They viewed it as a unilateral betrayal. France called it monetary imperialism. Germany scrambled to respond. Japan's central bank bought $1.3 billion in 2 days, trying to maintain the old exchange rate. But here's what's shocking. US financial markets loved it. The first day after the announcement, the stock market jumped 4%. 4% in one day. That's a massive move. Investors weren't panicking, they were celebrating. Why? Because the market understood what Nixon had just done. He'd removed an artificial constraint on the US economy. The gold peg had been forcing the Fed to choose between domestic growth and international commitments. Now that constraint was gone. The Fed could focus entirely on the US economy. Investors also understood that closing the gold window meant easier money, more liquidity, lower interest rates. That's good for stocks, good for real estate, good for any asset that benefits from inflation. Within weeks, the dollar started falling against other currencies. This made US exports cheaper and more competitive. American manufacturers cheered. The trade deficit started shrinking. Foreign exchange markets saw trading spreads increase tenfold as traders struggled to price currencies without the gold anchor. But after the initial chaos, markets adapted. By December 1971, the Smithsonian Agreement attempted to establish new fixed exchange rates with a devalued dollar. That agreement lasted only 15 months before collapsing under speculative pressure. By 1973, major currencies were floating. The era of fixed exchange rates was over, and the era of floating fiat currencies had begun. Why did breaking our promise make things better? This seems contradictory. The US broke a promise to 44 nations. We told them dollars were as good as gold. Then we said, actually, no, you can't have your gold. That's a default, a broken contract. Why did markets go up instead of crashing? Because the promise was already broken. Everyone knew it. The system was insolvent. Pretending otherwise was creating worse problems. Think about it like this. You're lending money to someone who promised to pay you back. You discover they're bankrupt. They can't pay. At that point, you have two options. Option one, they keep pretending they can't pay, keep borrowing more to make interest payments, and the debt keeps growing until the inevitable catastrophic collapse. Option two, they admit they can't pay, restructure the debt, and start fresh. Option two is painful, but it's less painful than option one. That's what Nixon did. He admitted the system was broken instead of pretending it could continue. This allowed markets to adjust to reality instead of being surprised by a chaotic collapse later. The alternative would have been worse. If Nixon had tried to defend the gold peg, the Fed would have been forced to raise interest rates dramatically, maybe to 10 or 15%, to attract dollar holders and slow the gold drain. That would have crashed the stock market, spiked unemployment, and triggered a recession in 1971 instead of 1973. Or Nixon could have let the gold run continue until Fort Knox was empty. Then what? A panicked emergency closure with no plan, no coordination, and global financial chaos. Here's another critical point. What if Nixon had closed the gold window earlier, say in 1965, instead of waiting until 1971? It might have been better, seriously. Think about what happened between 1965 and 1971. The US escalated the Vietnam War. Military spending exploded. Casualties mounted. The war became deeply unpopular, creating domestic political chaos. The Great Society programs expanded. Medicare and Medicaid launched. Spending on poverty programs increased. All of this required deficits and borrowing. The Federal Reserve printed money to keep interest rates low and unemployment down. Inflation accelerated. Foreign dollar liabilities quadrupled, while gold reserves continued to decline. If Nixon had closed the gold window in 1965, none of this additional damage accumulates. The Vietnam War would have been forced to end sooner because fiscal constraints would have kicked in immediately. The Fed couldn't have printed as much money because the inflation consequences would have been immediate and obvious without the gold window masking them. The 1971 crisis would have been smaller. The debt would have been smaller. The inflation problem would have been smaller. And most importantly, you avoid the 1973 oil crisis hitting a fragile, overextended system. This reveals something important. Sometimes admitting a system is broken early causes less damage than pretending it works and letting the problems compound. The 6-year delay from 1965 to 1971 didn't save the gold standard. It just made the eventual crisis bigger and more painful. By closing the gold window preemptively, Nixon controlled the timing. He announced it on a Sunday night when markets were closed. He packaged it with wage price controls and import tariffs to show he had a plan. He negotiated with other countries to create an orderly transition. Markets appreciated the honesty. The old system was dead. Admitting it allowed everyone to move forward instead of pretending and delaying. After Nixon closed the gold window, the Federal Reserve no longer faced an external constraint. The gold peg was gone. The Fed could print as much money as it wanted without worrying about gold redemptions. And they did. The money supply expanded rapidly. The Fed kept interest rates low to support growth and employment. Inflation, which was already rising under the gold standard, accelerated. U.S. inflation went from 5.8% in 1970 to 9.1% by 1975. That's a 57% increase in prices over 5 years. Your dollar in 1975 bought almost half what it did in 1970. The 1970s became known as the era of stagflation. Stagnant growth plus inflation, unemployment stayed high. GDP growth was slow, productivity declined. It was one of the worst economic decades in American history outside the Great Depression. The national debt exploded from about $370 billion in 1970 to over $900 billion by 1980. That's more than doubling in a decade, and it kept accelerating. By 2023, the national debt hit $36 trillion. Now here's where it gets really interesting. Gold prices tell the complete story of what happened. In 1971, when Nixon closed the gold window, gold was trading around $40 per ounce in the market. By 1980, gold hit $612 per ounce. That's a 15-fold increase in nominal terms. But let me show you what that means in real terms, adjusted for inflation. In 1971, gold at $40 per ounce was worth $100 in today's purchasing power. By 1980, gold had reached the equivalent of $4,200 per ounce in inflation-adjusted terms. That's the peak. Gold delivered a 42-fold real return in just 9 years. Why? Because the market was screaming, the dollar is losing value catastrophically. Get out of paper, get into hard assets. Over the entire period from 1971 to today, gold has risen 4,800% in nominal terms. But in real inflation-adjusted terms, the returns fluctuated wildly. Gold peaked in real terms in 1980, then declined through the 1980s and 1990s as the Fed regained credibility under Paul Volcker. During the Volcker era, starting in 1979, the Fed raised interest rates to 20% to break inflation. It worked. By 1983, inflation was below 4%. The economy entered what economists call the Great Moderation. Look at what happened to gold during that period. In 1980, gold was worth $4,200 in real terms. By 1991, it had crashed to just $336 in real terms, an 80% decline. Why? Because the Fed had regained credibility. Inflation fell from double digits to around 3%. When the Fed mimics the discipline that gold once imposed, gold becomes just another commodity instead of a monetary hedge. From the mid-1980s through the late 1990s, gold stayed relatively stable in nominal terms, around $350 to $400 per ounce, and inflation stayed low, around 2 to 3% annually. This was the Great Moderation. The Fiat currency system, managed well, delivered excellent economic performance. But then the cycle repeated. From 2000 to 2012, gold surged again from $252 to over $1,900 per ounce. In real terms, gold went from $187 equivalent to $740 equivalent, a fourfold real increase. Why? Because the Fed started printing money again after the dot-com crash, and then massively after the 2008 financial crisis. The market saw inflation coming, and gold became a hedge again. And then look at what happened recently. Inflation cooled throughout 2010s, staying around 2%, but then the pandemic hit. Inflation spiked to 7% and then 6.5% as the Fed printed trillions. Gold responded. It surged from around $1,700 in 2019 to over $2,000 by 2024. The market was pricing in inflation expectations and loss of dollar credibility. So was ending the gold standard a disaster? Not exactly, because here's what people forget. The alternative was worse. If Nixon had defended the gold peg in 1971, the US would have entered a severe deflationary depression. Unemployment would have spiked to 15, maybe 20%. Wages would have fallen. Businesses would have failed. Banks would have collapsed. The government couldn't have borrowed to cushion the blow because borrowing would have triggered more gold redemptions. Think about the Great Depression. Unemployment hit 25%. It lasted a decade. One of the reasons it was so bad and lasted so long was because the US stayed on the gold standard until 1933, which prevented the Fed from printing money to ease the crisis. The 1970s were painful. 9% inflation destroyed savings. But unemployment peaked at 9%, not 25%. The economy kept growing, even if slowly. And by the early 1980s, the Fed under Paul Volcker regained control. The fiat currency system managed well, delivered excellent results. Not because fiat money is perfect, but because the Fed successfully mimicked the discipline that gold once imposed without accepting the rigidity that gold required. So, which is worse, inflation or deflation? Gold standard advocates point to the $36 trillion debt and say, we need gold to impose discipline. They're right that fiat currency enables debt and inflation, but they're wrong about the alternative being better. Deflation is worse than moderate inflation, much worse. Here's the mechanism. Inflation reduces money's value over time, which encourages spending and investment. Why hold depreciating cash when you can buy assets? Deflation does the opposite. When prices fall, cash becomes more valuable, so you wait to spend. Businesses see less demand, cut workers, which reduces spending further. The cycle reinforces itself into a death spiral. Debt becomes impossible under deflation. If you borrowed $100,000 and deflation runs 3% annually, the real value of your debt grows 3% per year while your income falls. You can't escape. The Great Depression proved this. Prices fell 25% from 1929 to 1933. Unemployment hit 25%. It lasted a decade because the U.S. stayed on the gold standard until 1933, which prevented the Fed from printing money to ease the crisis. The gold standard guarantees deflation during crises because the money supply can't expand when you need it most. Banks fail because they can't create liquidity. The Fed can't print to save them without threatening the gold peg. The fiat system allows the Fed to act as lender of last resort. In 2008, the Fed printed trillions to prevent bank failures. In 2020, trillions more to cushion the pandemic shutdown. Under gold, none of that happens. So the choice isn't between sound money and reckless printing. It's between deflation risk with no flexibility versus inflation risk with crisis response capability. Most people would rather deal with 5% inflation than 25% unemployment. That's the trade-off Nixon faced. Accept inflation risk to avoid deflation certainty. It wasn't perfect. It was the least bad option available. What can we do about this now? The debate about monetary policy isn't between good guys and bad guys. It's between two imperfect systems with different trade-offs. Understanding this helps you navigate what's coming. Here are 5 principles you need to know. First, governments always choose domestic survival over external commitments. Nixon faced that choice in 1971. Defend the gold peg and accept depression, or break the commitment and preserve growth. He chose growth. Every democratic government makes the same choice because they can't survive 25% unemployment. This tells you what happens in the next crisis. When the U.S. faces a debt crisis, currency crisis, or financial panic, the government will choose domestic stability even if it means breaking promises about the currency. Count on it. Second, watch gold prices as the markets vote on monetary credibility. The data shows the pattern clearly. Gold stayed stable in real terms during the low inflation 1980s and 1990s when the Fed had credibility. Gold spiked to over $4,000, equivalent in 1980 when inflation raged out of control. Gold surged again from 2000 to 2012 when the Fed printed trillions after the financial crisis. When gold rises fast, the market is saying, we don't trust the dollar. When gold is stable, the Fed has credibility. Right now, gold movements tell you what's coming before official inflation numbers do. Third, both inflation and deflation destroy wealth just in different ways. Inflation destroys cash and bonds. Your purchasing power evaporates. But real assets like stocks, real estate, and gold maintain value or appreciate. Deflation destroys incomes and employment. Wages fall, businesses fail, but cash becomes king. The gold standard guaranteed deflation during crises. The fiat system risks inflation. Pick your poison, but understand both destroy wealth if you're positioned wrong. Fourth, no monetary system is permanent. The gold standard lasted 100 years and died because it couldn't handle modern economic shocks. The current fiat system has lasted 54 years. Will it last another 50? Maybe. Maybe not. The system works when the Fed maintains discipline. It breaks when they print too much for too long. The Great Moderation proved it can work. The 1970s and post-2008 era proved it can fail. Fifth, the next crisis will force the same choice Nixon faced. When it comes, and it will come, the government will print money. They'll break commitments. They'll prioritize domestic stability over sound money promises. They have no other choice. So here's what you do. Accumulate gold. Not because gold is perfect, not because we're going back to a gold standard, but because gold is the asset that survives monetary crises. It survived when Spain debased silver. It survived when Britain left gold in 1931. It survived when Nixon closed the window in 1971. And it delivered a 42-fold real return when the dollar collapsed in the 1970s. The pattern repeats. The constraints don't change. When you understand how these systems break, you see the next crisis coming. And when everyone else is confused, you'll know exactly what's happening and where your wealth needs to be. And if this helped you understand how monetary systems actually work, subscribe. We'll cover more history so we know what's coming, because history repeats itself.